Have you ever heard the quote from Eleanor Roosevelt? Learn from the mistakes of the other, you won't live long enough to make them all yourself? Or the one from Charlie Munger? It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. Today's episode is about top investment mistakes I have observed and made in my career and how to try to avoid them. I think learning from the mistakes is one of the simplest ways to excel in investing. Today, a lot of people are very much focused into the next best investment ideas. And while this is important, I think it is even more important surviving the market and trying to stay the game. There are several biases in investing we need to be cognizant of. One of them is the confirmation bias, which is basically the tendency to search and look for information that confirm our pre-existing belief and values. It is so easy for our mind to search for confirming evidence, because it is also so difficult for it to accept contrarian ones. What on the contrary we should do is to research and find out information that are also going against our thesis. What, for instance, I'm used to do when I research a company is to always include a section that I call What Can Go Wrong, where I detail all the type of information that can prove my thesis to be wrong. When we deal with investing, we should accept the fact that we are gonna make a lot of mistakes. Another type of bias, which I like a lot, is the anchoring bias, which is basically the tendency of our mind to focus on the first piece of information that help us to shape a given thesis, disregarding the following one, which might prove our thesis to be wrong. Stanley Druckenmiller is a macro-based investor, focusing on macro theme. Over a 30-year period, he achieved a 30% annual return, therefore crushing its benchmark. He is famous for having shorted the Japanese stocks in 1989, as well as the British pound. He is a veteran of Wall Street and was surrounded by young guys during the tech bubble. Druckenmiller basically could not stand the fact that shorting tech stock was not paying off and therefore decided to join the tech party. Druckenmiller piled up a total amount of $6 billion and ended up losing half of them. Therefore, here we have one of the greatest investors of all time that got sucked into the greedy cycle of the tech bubble. So for me, the lesson here is always to slow down, to think about where your mind is and to keep your emotion in check. I usually do this by following a checklist before making any type of investment decision, because most of the time, doing nothing is the preferred course of action. I define trying to time the market, the attempt to define the time of your buys and sells depending on the market conditions. So let's say, for example, that you decide to sell your stock because it's up 20%. And let's say that, for example, over some years, the market proves your thesis to be right, and therefore you would have made 500% if you would have decided not to sell your stock. Another attribute of trying to time the market is when investors withdraw completely their capital from the market because they think they can anticipate a market downturn. This reminds me of a famous quote from Benjamin Graham, who was used to say that over the long run, the market is a waiting machine that tends to override short-term headwinds. So in a nutshell, I think that if your objective is to stay invested in the market for, let's say, 50 years, you should not even think about whether the market is over or undervalued, because the only thing that should matter to you is the fundamentals of the business. Leverage can allow you to increase your return by simply borrowing money. This is one of the easiest ways to completely destroy your capital. Charlie Munger was used to say that there are 3 ways in which an investor can go broke: liquor, ladies, and leverage. The problem in investing is that people that lend you money at some point want also their money back. So if your investment goes in the opposite direction that you thought, you are forced to sell it and to return the money. So the problem with leverage that I see is that people want to compress the time that it takes to reach their objective. So let's say that they want to become millionaire, and this might take 15, 20 or whatever years. But that is not enough because they want that in 5, 2 years. And this is where leverage kicks in, and this can create a big problem. If you have confidence in your investment thesis, know the business, have studied the sector, the industry, know the earnings, the cash flow, the balance sheet, then you should be fine if the market takes an opposite view and maybe also punishes the stock for a short period of time. This is in a nutshell the essence of value investing. The opposite of that is speculation, which I would define as lack of knowledge. What I like about investing is that the market finds always different ways to test your emotion and knowledge about the stock. There will always be a lot of uncertainties as no one has a crystal ball, but we can try to minimize this uncertainty by doing a proper research on the company, studying the business, the sector, the industry, looking for companies that have a strong balance sheet, that have consistently grown the earnings and revenue over time, and that have a strong return on invested capital, and maybe also by adopting a margin of safety. So there are really tons and tons of people with high IQ that invest into the market. However, having a high IQ does not necessarily guarantee great investment return. Investing at its very core is about finding undervalued businesses, holding them until the market price converges with the value. But people tend to make it more difficult and complicated than what in reality this is. So, one of my favorite examples about lack of investment acumen comes in the form of Isaac Newton, who was one of the greatest scientists of all time. So basically, Isaac Newton lost almost all its money because he invested into the South Sea bubble. So what is really important to understand is that, for instance, assuming insane growth rate just because Bloomberg or the CNBC tells you that that sector or that particular stock are expected to grow forever is not really a great idea. You should always do your own research and adopt your own investment framework before making any type of investment decision. And here we come to the last of our investment mistake. So Warren Buffett is used to say, price is what you pay, value is what you get. This is a very elegant yet powerful message. So the difference between what you pay and what you get is at the very core of value investing, but yet most of the people don't really get it. So in the market, you have many people contributing to set the price of the stocks. And despite this being quite an efficient process, you cannot expect the market to be right 100% of the time. So for instance, if you have Apple in your portfolio and you are convinced about your investment thesis, you should be happy if you observe a market drawdown, because this temporary misalignment between the market price and the value of Apple gives you the possibility to enter again into your position. Another mistake that I observed in beginner investors is to consider cheap or expensive a stock just based on its dollar value. So for instance, people might consider a $1 stock cheaper compared to a $100 stock. So if you know the difference between price and value, this is obviously wrong, because if the value that you get for the $1 stock is 50 cents, then even a $1 stock is expensive. And this reminds me also of the transition that Warren Buffett exhibited throughout the time from cigar butts, deep value stock, to quality. In fact, it is important to understand that the alignment between the market price and the intrinsic value is just one of the ways in which investors can get a return. In fact, let's assume that you have a stock whose market price is perfectly aligned with the intrinsic value. However, that stock is consistently adding 20%, over 20% each year to its earning. Over time, you will see the intrinsic value of that stock to grow, and therefore to reward you as an investor if you are able to stick to your investment over the long run. Making money in the stock market is extremely difficult. If you don't trust me, check yourself how many great investors lost billions of dollars, or how many active investors don't manage to beat the S&P 500. When it comes to investing, if there is one certainty, is that you're gonna make a lot of mistakes. Psychologically, dealing with mistakes when it comes to investing can be extremely difficult. However, if you take the time to learn from your past mistake and to study the mistakes that have been made by the others, this is the most powerful decision that you can take, which is gonna bring you a step closer to becoming a successful investor.